Japan's economic miracle was a mirage, built on air, destined to collapse. For decades, the world watched in awe as Japan rose from the ashes of war to become an economic titan. Its corporations dominated global markets, its technology was cutting-edge, and its people enjoyed a standard of living that seemed to defy gravity. But beneath the glittering surface of prosperity, a dangerous bubble was inflating, fueled by speculation and hubris that would eventually shatter a nation's wealth. By the mid-1980s, Japan was riding an unprecedented wave of success. Its GDP was second only to the United States. Its national pride soared, yet a subtle shift began to occur. Instead of reinvesting in productive industries, capital started flowing into real estate and stocks, driven by a belief that prices would only ever go up. The Plaza Accord in 1985, an agreement among the G5 nations to depreciate the US dollar against the Japanese yen and German mark, inadvertently accelerated this process. While intended to correct trade imbalances, it made Japanese exports more expensive, prompting the Bank of Japan to slash interest rates to stimulate the domestic economy. Lower interest rates meant cheap money. Corporations and individuals alike could borrow vast sums with ease. This liquidity wasn't channeled into innovation or expansion, but directly into speculative assets. Land, especially, became the ultimate investment. People genuinely believed that land in Tokyo was more valuable than all of California. Imagine a postage stamp-sized plot of land in central Tokyo, selling for millions of dollars. That wasn't an exaggeration. Land prices in Tokyo alone skyrocketed by over 300% between 1986 and 1991. The Imperial Palace grounds, a relatively small parcel, was rumored to be worth more than all the real estate in Canada. This wasn't just wealthy investors. Average citizens, swept up in the euphoria, took out massive loans, using their homes as collateral to buy more land or stocks. They believed they were participating in a national triumph, a golden age where everyone would get rich. The stock market mirrored this frenzy. The Nikkei 225 index reached an all-time high of nearly 39,000 yen on December 29, 1989. Companies with little underlying value saw their share prices soar. It was irrational exuberance on a scale rarely seen, fueled by cheap credit and a collective delusion. Banks were complicit. They lent money with reckless abandon, often accepting inflated real estate as collateral, assuming the value would never drop. This created a dangerous feedback loop. Rising land prices justified more loans, which in turn pushed prices even higher. The symptoms of excess were everywhere. Golf course memberships, once a luxury, became an investment vehicle, trading for millions of yen. Exclusive restaurants, serving gold leaf-infused dishes, were packed nightly. Japanese tourists flooded the world, buying up luxury goods and properties in places like Hawaii and New York. But the party couldn't last forever. Prudent voices, though few, warned of the impending crash. The Bank of Japan, finally recognizing the grave danger, began to raise interest rates sharply in 1989 and 1990, attempting to rein in the runaway speculation. The effect was immediate and brutal. On the first trading day of 1990, the Nikkei 225 plunged. It continued its downward spiral throughout the year, losing over 40% of its value. The illusion of perpetual growth shattered, exposing the fragility of the entire system. The real estate market soon followed. With higher interest rates, mortgage payments became unbearable for many. As people tried to sell their properties, they found no buyers. Prices plummeted, leaving millions with negative equity owing more on their loans than their properties were worth. The impact on banks was catastrophic. Their balance sheets were filled with non-performing loans backed by now worthless collateral. Many faced insolvency. The government was forced to intervene, injecting vast sums of taxpayer money to bail out struggling institutions, but it was a slow, painful process. This was the beginning of Japan's lost decades, a period of prolonged economic stagnation, deflation, and low growth that stretched through the 1990s and beyond. It wasn't just a financial setback. It was a profound psychological blow to a nation that had believed itself invincible. Companies that once dominated the global stage struggled. Lifetime employment, a cornerstone of Japanese corporate culture, eroded. Young people, often called freeders, found themselves in precarious, temporary jobs, facing a future far less secure than their parents' generation. The legacy of the bubble economy isn't just financial. It reshaped Japanese society, fostering a sense of caution and risk aversion that persists to this day. The collective memory of that sudden, devastating fall has cast a long shadow over entrepreneurial spirit and investment. What can we learn from Japan's experience? The bubble was a classic case of market irrationality, amplified by cheap money and a herd mentality. It shows how quickly prosperity can turn to peril when fundamentals are ignored in favor of speculative gains. It also highlights the critical role of central banks. Their actions or inactions can either stabilize an economy or inadvertently fuel dangerous bubbles. The Bank of Japan's initial reluctance to act, followed by its aggressive tightening, both contributed to the severity of the boom and bust, and the dangers of moral hazard are clear. The implicit government backstopping of banks, even after their reckless lending, sent a signal that risks would be socialized, while profits remained privatized. This can incentivize future risky behavior. Today, as global markets grapple with inflation, interest rate hikes, and geopolitical uncertainty, the lessons from Japan's lost decades remain strikingly relevant. The allure of easy money and rapidly rising asset prices is potent, but the consequences of their collapse are often far-reaching and deeply painful. The story of Japan's bubble economy is a cautionary tale, a stark reminder that even the most robust economies can be brought to their knees by unchecked speculation and a collective refusal to acknowledge reality. It serves as a permanent scar on the nation's economic psyche and a lesson for all nations. Explore the next financial collapse that rewrote the rules of banking.